This is Luke Robinson with Collective. I'm actually a new business advisor here with Collective. We're an all in one financial solution for your self employed situation. We will make you into an S Corp. We'll run your payroll, your bookkeeping, provide tax advice throughout the year. And at the end of the year, we'll handle your business tax filings. But today, well, first of all, happy Halloween, happy All Hallows Eve. I can't believe I didn't mention that. I hope everyone gets sick tonight on candy and has a lot of fun. But before we do that, before we go and enjoy the celebration of our harvest, let's talk about taxes. And today is a session, what we like to call Tax Tuesday. And essentially what it is, it's an AMA. It's an Ask Me Anything about anything about taxes. And also, to kind of get the legal things out of the way first, this is an educational session only. Don't take this as official tax or legal advice. It's not. It's educational. Before you act on anything, before you act on this advice, go to a tax professional. Go to someone that you're contracted with to handle your situation. This is just purely educational. But let's get going. And I believe we already have a few questions that I can go ahead and answer. The first one, Collective. I've seen online that Collective has a deadline of October 31st to backdate an S Corp election. Could you tell me why? You're correct. Collective and other companies like us have certain deadlines that we, sort of mark down to where it's the deadline to backdate an S Corp election. And the reason that is when you backdate an S Corp election, there's some work involved. You got to go back and run back payroll, because that's one thing that'll happen when you're an S Corp. You'll literally be on payroll. So that's one thing. You got to go back and clean up your bookkeeping to include a balance sheet. That's another. So, in order to backdate an S Corp election, it's not just simply, filling out a form and sending it into the government. There's a lot of, other administrative steps that you got to take. Now, it's not an official deadline. Like, it's not an IRS deadline. You can technically go all the way to the, 31st of December, the last day of December, and backdate your S Corp election. That's technically possible, but it's usually extremely expensive. And this tax attorneys, CPAs, they can routinely charge, $6,000 to $10,000, a year to go back and do work like that. And a lot of times it makes it not worth it, because the amount that you pay a tax professional to do all this for you, a lot of times will be more than what you save in the S Corp. So that's the reason why that we have a deadline. And that's the reason why a lot of companies have a deadline for something like this. Oh, well, that brings me to my next question. How do you save money with an S Corp? Well, essentially, you save money with an S Corp by saving on the self-employment tax. That's the whole reason why you'd want to become an S Corp. Before you become an S Corp, essentially all of your money is subject to the self-employment tax. The self-employment tax, it's a flat tax rate of 15.3%. So, for example, let's say that you have a self-employed business and you're making around, $120,000 a year. Before you become an S Corp, how you'd come up with your self-employment tax is you take 120 grand and you'd multiply it by 15.3%. All of your money is subject to it. When you become an S Corp, or when you make an S Corp election, that's a technical name for it. First, you'll set up an LLC. Then you'll send in paperwork to the IRS to make an S Corp election. You send that paperwork into the feds. And what that does is technically it creates an employee-employer relationship between you and your own LLC, between you and your own business. You're still the owner of your business. Of course, you're still listed as the owner on your company formation documents. Legally speaking, you still own the business. But for tax purposes, you literally become an employee. And since you're an employee of your own business, your business will pay you a wage. It'll pay you a salary just like you'd receive if you work for someone else, as a W-2 employee. But the advantageous sort of thing about S corps is that the only chunk of your earnings that's subject to the self-employment tax is your salary. So going back to my earlier example, let's say that in total your business makes 120 grand, and let's say that you pay yourself $60,000. Let's say that that's a reasonable salary for your particular situation. That first 60,000 is still subject to the self-employment tax. You still pay it. You can kind of think of it as a payroll tax at that point. The other 60,000, or just the rest of your money, outside of your salary, that is considered a distribution to yourself. That's a technical name for it. You can conceptually speaking, you can think of them almost as dividends. That chunk of money, that 60,000, is not subject to the self-employment tax at all. So, how you'd come up with your tax savings if you were making 120 grand is you take your $60,000 distributions and you'd multiply it by 15.3%. That's what you would otherwise pay if you weren't an S corp. That comes out to $9,200 a year that you'd save in the self-employment tax. And that's close to 10% of your net income right there. So, it could be particularly important, like, once someone reaches a certain income level, to make an S corp election. Because at the end of the day, this is your money. You're a self-employed business owner. You work hard to make your own money. You sacrifice your blood, sweat, and tears. And you really should sort of employ any strategy that you can to lower your taxes. Here's a good question. What are the tax consequences of missing payroll? Well, thankfully, so now don't get me wrong. It's important to pay yourself, to run payroll on a consistent basis, on a consistent basis throughout the year. So it's important to either pay yourself weekly, monthly, bi-weekly. It's important because it looks better. It's more organized. If you were ever audited, it looks better for the auditor. It looks better for the IRS if things are organized. However, let's say that you miss payroll. Let's say that you miss a month. You miss 2 months. It's okay. It's not a big deal. You still have time to fix it. What's the most important part about this is how much you pay yourself in salary. What is the ratio between how much you're paying yourself in salary and how much you're paying yourself in distributions? Because people will ask me, well, if I'm only subject to the self-employment tax on my salary, then why not just pay myself a super low salary? Instead of $60,000, why not just pay myself $5,000 or $10,000? And my response is because likely your chances of audit raise substantially. The salary, the amount of salary, not when you pay it, but the amount has to be reasonable, has to be a reasonable amount. So if your business in total is making 120K and you pay yourself $10,000, the IRS could very well deem that to be unreasonable. They could audit you, they could go back and penalize you, and then you'd have to go back and pay, the back payroll taxes that they say you owe, plus usually penalties and interest. So what's important is that in the tax year, you pay yourself a reasonable ratio, which is typically between 30 and 40%. That's a general rule of thumb. It's not exact, but it's general rule of thumb to where if you're at least in that ratio, you're typically pretty safe from audit if you do that. But then you pay personal income taxes. Yes, you do, but you pay personal income taxes regardless. So before you become an S corp, like let's say that you make 120 grand, you're paying personal income tax on all of that money. And then when you become an S corp, you're paying personal income taxes on your full net income, just like you were before you were an S corp. So the income tax doesn't change. You're not going to increase your income tax by becoming an S corp. It stays the same. The only tax rate that is different is the self-employment tax. Because in the US, you're thinking of two main tax rates. You're thinking of the income tax and you're thinking of the self-employment tax. Completely separate tax rates, and you pay both of them. But before you become an S corp, all of your money is subject to the self-employment tax as well as the income tax. But when you become an S corp, the only chunk of your money that's subject to the self-employment tax is your salary. So, don't worry too much about the income tax. It's kind of a moot point. The only tax that's going to change is your self-employment tax, and that will go down if you make an S corp election. Just, sort of logically speaking, it will go down if you're paying yourself a salary with an S corp election versus before when you're just an LLC and not paying yourself a salary. Okay, Julietta asked a question. If the S corp is in a sue situation, I don't really know what that means, but if you mean, can the S corp be sued? Yes, but the thing is, when you create an S corp, you have to create something like an LLC before you can even elect S corp tax status. So the LLC should give you legal protection and separation between your business assets and business income from your personal assets. So making the S corp election doesn't what I should say, take away the legal protection. It has nothing to do with it. The S corp is a tax election, and you're getting that legal protection from your LLC, which is the basis under that S corp tax election. Do you have to form an LLC before becoming an S corp? Can you make an S corp directly? No, it's impossible. You can only make an S corp election on a business entity. So there's three main types. There's a single member LLC. You can make an S corp election on that. You can also make an S corp election on a multi-member LLC. In other words, a partnership. That's what a multi-member LLC is. That's literally a partnership. So you can make an S corp election on a partnership. You can also make an S corp election on a corporation. You form a corporation with your state of residence, just like you form an LLC, and you can make an S corp election on a corporation. However, a vast majority of self-employed business owners does not need a corporation, because they don't. Because the only reason why you'd want to form a corp or form a corporation, a C corp, is if you ever wanted to go public, is if you ever wanted to literally list your business on a stock exchange, issue stock in your business. If you want a little bit more flexibility in terms of ownership with your business, with an S corp, an S election, with an LLC S corp, and a corp S corp, you can only have 100 owners in your business. But with a C corp, a corporation, you can have an unlimited amount of owners. Like, there's as many people as you want can own an interest in your company. But when you make an S corp election, only 100 people can. But again, that only a very small amount of self-employed individuals need to have over 100 owners in their business. So, and the downsides with the corporation is that you have additional sort of administrative requirements when you're a corporation as opposed to an LLC. You have to have a board of directors. You have to keep a corporate ledger. You have to take record board meeting minutes and all that, those sorts of things. So it's harder on an administrative level. And a corporation doesn't provide you any additional legal protection. It doesn't provide any additional separation between your personal assets and your business assets. An LLC does that for you. So all you're doing when you form a corporation and make an S corp election is you're putting additional administrative burdens on yourself for no financial or legal benefit. All right. What is the most common write-off business expense that you see people miss? Ooh. The most common write-off that I see people miss, it's not really a write-off, but it's something that a lot of people don't sort of take advantage of, are self-employed retirement accounts. When you become self-employed, your ability to save for retirement increases substantially. There are some situations to where you can save up to $60,000 in tax-free retirement contributions. Now, when you're an employee, like when you work for someone else, when you're not self-employed, you can usually only contribute up to the individual limit, which is around, between $20 and $23,000. I'm not sure exactly what that limit is, but typically you can only save up to that limit. When you're an S corp, when you're a self-employed person, you can go all the way up to 60 grand. So, that's a pretty big deal right there. So I guess that's what I would say. Um, okay. Ownership is something I wanted to know about, and what type of action can the IRS take over the S corp? Well, the main sort of area that the IRS is looking at, and that the IRS is looking at, is the amount of salary that you take. The salary can't be too low. So when you make an S corp election, you pay yourself a salary, and you also file an S corp tax return at the end of the year. It's called an 1120S tax return. So on that 1120S, it will list how much you've paid yourself in salary and how much you've paid yourself in distribution. Those numbers have to be reasonable. The salary can't be too low. If the salary is too low, the IRS could audit that tax return. They could audit you, and they could say, no, you didn't pay yourself enough in salary, so we are going to create a new salary for you. So let's say that you paid yourself $10,000 in salary, and the IRS, in their opinion, an $80,000 salary is more reasonable. They will bump up your salary to 80 grand, and they'll demand the self-employment tax that you didn't pay on the difference of that $70,000. So they'll demand that 15.3%, and they'll also tack on penalties and interest because of that too. So, if you hadn't been putting money back for your taxes, you could end up with a huge tax bill, if you just kind of immediately, if you pay yourself too low. So keep that in mind. That's really important. But if you pay yourself a basically reasonable salary, typically it's pretty rare, to even be audited. That's the red flag they look at, is the amount that you pay yourself in salary. I reached out last week and we had a Zoom appointment and talked about my taxes, but still never received the onboarding email from you yet. I apologize. I'm not really sure what happened there. Sometimes there are, some glitches in the emails getting sent out. Let me look into it right after this session, and I'll make sure you get that email. All right. In what situations would you want to become a C corp over an S corp? Well, okay, that's a good question. Really, the only situation, like I mentioned earlier, is if you wanted to have a lot of owners in your business, more specifically over 100 owners. So a corporation has more flexibility with how they issue ownership. Like I said, you can issue stock. It's easier to sort of give people a portion of ownership of your business. That's really the only sort of benefit that I can think of with becoming a C corporation. Now, it's still possible to form a C corporation and avoid the double dipping on the tax, because the thing is, when you form a corporation without an S corp election, you're taxed twice. You're taxed once at the corporate level, to where the corporate net income gets taxed a corporate tax rate, and then you're taxed again when that corporate net income is sent out to you, either in dividends, in salary, or things like that. You can make it to where you zero out the net income of the corporation, in the sense to where, if you own a corporation, that corporation is going to be paying you a salary. It's going to be paying you a wage if you work for your own corporation. That salary that the corporation is paying you can be written off by the corporation. So let's say the corporation has a net income of $120,000, But let's say that that same corporation is paying you as the owner $120,000 salary. That corporation now has a net income of zero. There's no corporate tax on its zero net income. So you don't pay corporate taxes, but you'll still pay the self-employment tax and income tax on the salary that you're paying yourself. Okay. All right. How do you make an S corp election on a partnership? Well, the same way you do on a single member LLC, on just a one person business, and you will send in for you'll create the partnership, which just simply means forming a multi-member LLC, forming an LLC with two or more people on it. That's what a partnership is. So once you have that in place, you'll have that in place. You'll form that with your state of residence, wherever you live. You'll form that LLC with them, and then you'll make an S corp election with the Internal Revenue Service, with the IRS, on Form 2553. However, I would encourage you not to do that yourself. There's a lot of moving parts. There's a lot of ways to mess up on that. I would employ a tax professional to do that for you. But yeah, you can make an S corp election on a partnership just like you can on a single member LLC. Do you still have to file a personal tax return when you make an S corp election? Yes, you do. You still have a personal tax return. You have an additional tax return that you have when you make an S corp election. You have an S corp tax return. It's called an 1120S. And that one's due by March 15th every year. So that one's due, you file that one by March 15th. And then from there, a K-1 is issued. And a K-1 essentially is a document that shows the financial information of your S corp. You take that K-1 and you plug and chug numbers on your personal tax return. And that's how you file that one. So you'll still have your personal return. You'll now have two tax returns when you make an S corp election. Can you still take the home office deduction when you form an S corp? Yes, you can. So the home office deduction is essentially writing off a portion of personal expenses if you work from home, like your mortgage interest, your rent if you rent, your utilities, HOA bills, cleaning fees, things like that. And how you do that is you take the total square footage of your dwelling, of your residence, and you also measure the square footage of your business use of home, the area, your home office, the area that you're using for business. So let's assume that your house is 3,000 square foot. We all wish, right? Let's also assume that the business, the square footage of your business use of your home is 1,000 square foot. That's 33% of your home that's used for business. You can take that 33% and you can multiply it by shared expenses, like your utilities, your mortgage interest, things like that. And you can still do that when you're an S corp. How the accounting works is a little bit more complicated and it's a little different. In order to write off those personal expenses with an S corp, you have to set up what's called an accountable plan. And essentially what happens is the S corp will reimburse you, will put money from the business bank account, transfer it into your personal bank account that is equal to your personal expenses. So your portion of your interest, things like that. The S corp will reimburse you for that. It's a write-off for the business. On the S corp tax return books, it's a write-off. And when you receive that money personally, it's not taxable to you personally because it's a reimbursement. So that's how you write it off. And again, that's just kind of complicated accounting speak. When you're an S corp, I would employ a tax professional handle it for you. Can you form an LLC to manage your rental properties that are titled personally? Yeah, you can, but the thing is, though, you'd need to switch over the title to your LLC. And to be quite honest with you, I'd go to a tax attorney to do that. I would go online to Rocket Lawyer or a place like that, and what they'll do is there's ways to switch over a title from yourself personally over to a business. But yeah, you can do that. Now, in certain situations, you can't. Like, let's say that you take out an FHA loan and you haven't reached the 1 year limit to where you can start renting it out. When you take an FHA loan, you're supposed to live in that house for a year before you start renting it out, before you move out and start renting it out. So keep that in mind. Now, as long as you're living there, it's fine. You can have an FHA loan, live on your property, and rent out certain rooms for your house, but you have to be living there. Okay, I think I have time for one more question. Is it too late to become an S corp this year? No, it's not. And like I said, Collective specifically, we have a deadline of today to still sign up and still receive a backdated S corp election to July. So it's not too late, but with Collective specifically, you would need to sign up with us today. But like I said, you can go all the way until December, to the end of December, to backdate an S corp election. Just be prepared to pay a tax attorney or a CPA a lot of money to do so. And that's all the time that I have today for our weekly Tax Tuesday. I enjoy it like I do every week, and I hope to see all of you next week for another Tax Tuesday.